If you are 65 or older, or if you have a parent, grandparent, or loved one who is a senior in America, I need you to pay very close attention to the next few minutes of this video. The IRS has quietly rolled out a new rule that is already affecting millions of retired Americans, and the overwhelming majority of seniors have absolutely no idea it exists. This is not a minor technical change buried in a tax code footnote. This is a real, significant update that can change how much money you owe, how much you keep, and in some cases, whether you face a penalty you never saw coming. By the end of this video, you will know exactly what this rule is, who it affects, and precisely what you need to do right now to protect yourself and your family. Welcome to Anderson Report, your most trusted source for breaking down the news, policies, and government decisions that actually impact your everyday life in America. I am glad you are here today because what we are covering is the kind of story that the mainstream media glosses over, but that real Americans, especially hardworking seniors who built this country, absolutely deserve to know about. If this is your first time here, please subscribe to Anderson Report and hit that notification bell so you never miss a story that matters. Now, let us get into the details because there is a lot to cover and every single part of it is important. To understand why this new IRS rule is such a big deal, we need to start with a little background on how taxes work for seniors in the United States. Most retired Americans are living on a combination of Social Security benefits, retirement account withdrawals from accounts like 401k plans and IRAs, pension income, and in some cases investment income from savings and stocks. For decades, the tax treatment of these income sources has followed a relatively predictable set of rules, and most seniors either had an accountant handle their taxes or followed the same approach year after year because nothing seemed to change. That predictability is now over. The IRS, working in coordination with updated guidance from the Treasury Department, has implemented new reporting and withholding requirements that specifically target income received by Americans aged 65 and older. The core of this change has to do with how required minimum distributions, commonly called RMDs, are now being calculated, reported, and in some cases automatically withheld. If you have a traditional IRA, a 401k, a 403b, or any other tax-deferred retirement account, this affects you directly. Here is what changed. Under the previous rules, the IRS used life expectancy tables that were last updated years ago to calculate how much money you were required to withdraw from your retirement accounts each year once you reached a certain age. Those tables have now been updated again, and the new calculations are producing different required withdrawal amounts for a significant portion of retirees. For some seniors, the new RMD amount is lower than what they were previously required to take out, which sounds like good news. But here is where it gets complicated. The updated reporting requirements mean that financial institutions, meaning your bank, your brokerage, your investment firm, are now required to report your RMD information to the IRS with a much higher level of detail than before. Discrepancies between what your financial institution reports and what you actually withdrew or what you reported on your tax return are now being flagged automatically by IRS software. This matters enormously because the penalty for failing to take your required minimum distribution correctly is one of the harshest in the entire tax code. Until very recently, if you missed or underpaid your RMD, the IRS could charge you a penalty equal to 50% of the amount you should have withdrawn, but did not. That is not 50% of your tax bill. That is 50% of the entire missed distribution amount. Congress did reduce this penalty to 25% as part of recent legislation, and in some cases to 10% if corrected quickly. But even at the reduced rate, this is a devastating financial blow for a senior living on a fixed income. Now, here is the part that has not been widely reported. Because the new life expectancy tables have been updated and because financial institutions are now reporting to the IRS under the new system, there is a mismatch happening for many seniors who are still using old worksheets, old accountant templates, or old financial planning tools to calculate their RMDs. They are coming up with one number, and the IRS system is expecting a different number. When those two numbers do not match, it triggers a review. Some seniors are already receiving letters from the IRS as a result of this mismatch, and many of them are confused because they genuinely believed they followed the rules correctly. There is also a second major component to this new IRS rule that affects seniors who receive Social Security. For years, the threshold at which Social Security benefits become taxable has remained unchanged, while the actual cost of living and benefit amounts have steadily risen. What this means in practice is that more and more seniors are crossing into the taxable range for their Social Security income without any change in their real purchasing power. The new IRS guidance includes updated provisional income thresholds and reporting codes that affect how Social Security income interacts with other retirement income on your tax return. If you have a financial advisor or tax preparer who is not up to date on these changes, your return may be filed incorrectly, and the IRS computers will find it. The third element of this rule change involves seniors who are still working part-time while collecting Social Security or drawing from retirement accounts. The earned income rules for this group have been updated, and the interaction between wages, retirement withdrawals, and Social Security benefits is now being calculated differently for tax withholding purposes. If you or someone you know is in this category, your employer's withholding may no longer be accurate for your actual tax situation, which means you could end up with a surprise tax bill next April. So what should you actually do about all of this? The first and most important step is to contact your financial institution right now and ask them specifically what RMD amount they have calculated for you under the updated IRS life expectancy tables. Do not assume your old calculation is still correct. Get the new number in writing. If your institution cannot give you that number clearly and confidently, that is a problem you need to address immediately by speaking with a qualified financial advisor or CPA. The second step is to review your tax withholding elections on any retirement accounts from which you are taking distributions. Many seniors set their withholding elections years ago and never changed them. With the new reporting requirements, it is worth sitting down and verifying that the withholding you have elected is actually sufficient to cover your tax liability under the current rules. An underpayment of estimated taxes can result in additional IRS penalties on top of the regular tax bill. Third, if you receive Social Security and have other income sources, use the IRS Withholding Estimator tool available on the official IRS website at irs.gov to get an updated picture of your total tax liability. This tool has been updated to reflect the new guidance and can give you a clearer picture than any old worksheet or outdated calculator. Fourth, be extremely cautious about any unsolicited calls, emails, or letters claiming to be from the IRS and offering to help you navigate these new rules. Scammers are absolutely exploiting the confusion around this rule change to target seniors, and reports of IRS-related fraud targeting retirees have spiked significantly in the past several months. The real IRS does not call you to demand immediate payment, does not ask for gift cards, and does not send unsolicited emails asking you to click a link. If you receive anything suspicious, hang up or delete it and report it to the IRS directly at their official website. Finally, if you have a tax professional, call them before the next tax season and specifically ask them whether they are up to date on the new RMD life expectancy tables, the updated Social Security provisional income rules, and the new reporting requirements for retirement income. If they are not familiar with these changes, it may be time to find someone who is. This is exactly the kind of story that Anderson Report exists to bring you, because the people who need this information the most are often the last ones to hear about it. The IRS is not going to send every senior in America a friendly letter explaining these changes in plain English. It is up to us to find this information, understand it, and share it with the people we care about. If this video helped you or someone you know, please give it a thumbs up and share it right now, because there are millions of American seniors who need to hear this before it costs them real money. Leave your questions in the comments below, and our team at Anderson Report will do our best to address them. Subscribe to Anderson Report if you have not already, and turn on your notifications so you never miss a story this important. We will see you in the next one.